this is all about culture, right? And we've been talking a lot about it. And you go, well, how can the Tax Reform Act affect culture? Think about it. We talked about it a little bit earlier. What certain companies have been doing since the Tax Reform Act was passed. And taxes seems a little bit boring, except when you see minimum wage at Walmart increasing, for example, $11, and you have these various bonuses that have been issued, okay, by a lot of major companies. But just, I'd like to start out just from your standpoint, Jed, as the founder and the head of now what's a 40-man firm, growing in a very dynamic environment. What's your take on tax reform and its impact on the culture within some of these companies? You think about it from an entrepreneurial standpoint.
Obviously, from the large public companies, there's more cash for the employees, more cash to invest in employees' growth, their education, and also more cash for the investors. So from a big company point of view, dropping the corporate rate to 21% is outstanding. From a macro basis in the U.S., it's going to bring investment to the United States. We have in our portfolio of clients many foreign-owned businesses that operate here in Orlando, and they are all obviously ecstatic because their return on their investment is just, increased by 40% just by a drop in the tax code.
Very cool. All right. Well, let's just get down to it. We started. Actually, I'm going to move this since that's about us. The Tax Reform Act, is with the change in the withholding tables that took place basically last week. There's a number of changes on a personal level with deductions and things like that. So folks are asking, well, what deductions are still there?
Sure, yeah.
with the new law.
Yep. Obviously the big change is on the Schedule A itemized deductions. There's a big increase in the standard deduction that if you're married and file a joint return, it's increased to $24,000, which is going to eliminate a lot of itemized deductors right from the get-go. They will not need to itemize because the standard deduction will exceed what they had traditionally had on Schedule A as itemized deductions. Big changes is obviously you probably heard about all the scuttlebutt about the big state taxes and the elimination of state and local taxes. That includes income tax, sales tax, and property tax will be now limited to $10,000 per return. So the Californias, the New Yorks, the Connecticuts, New Jerseys are really disadvantaged now because of that. Mortgage interest has also changed quite a bit. There used to be a cap of $1 million on what they call acquisition debt of mortgage, and that could be on your first or second home, but it couldn't be more than $1 million. Anything above that was non-deductible. That number is now dropped to $750,000. So, and that's on acquisition debt. And there is a grandfather clause that if you had $1 million mortgage, you can still deduct it above $750,000. And if you refinance that $1 million mortgage, you can still deduct it, and that is also grandfathered in. The other thing is the home equity loan. A lot of people have used home equity loans in the last 10 to 15 years to buy cars, to buy boats, to buy vacations, whatever, because they could choose to do whatever they wanted for the first $100,000 of that home equity loan and deduct the interest without question. Home equity loan interest is no longer deductible. The other big thing is itemized, miscellaneous itemized deductions subject to the 2% limitation. Those include tax prep fees. They include employee business reimbursement expenses, investment fees. Those are no longer deductible. And lastly is the charitable deductions. They have been retained. You can still deduct all your charitable deductions. The threshold used to be 50% of AGI. It's now up to 60% of AGI, which is adjusted gross income. The bad part is a lot of people would give to get, and they receive the tax deduction. Now with the standard deduction be at $24,000, there's a lot of concern that people's charitable giving may decline. Hopefully we won't see that, but there is a concern.
Very good. Okay, let's talk about some of the, I mean, just, I guess, a common question with wage earners who have children and the child tax credit.
Yeah, the other thing that was eliminated was your personal exemptions. So if you were a family of four, you would get about $16,000 of personal exemptions. The personal exemption is gone. So, but in replace of that, there's a child tax credit up to $2,000 per child who is in your household and is under the age of 17. That used to be a little bit lower than $2,000, excuse me, but it phased out very quickly, so not too many people could take advantage of that child tax credit. But now the phase out goes all the way up to $400,000 of taxable income. So most households that have children will get the benefit of the tax credit.
Time to have more babies.
Yes. Yeah. And part of it is refundable. If you have no tax liability and you have a household of children, there's potential that you could actually get a check back from the IRS versus just a reduction in your taxes. And the one other thing is if you have a grandparent that lives with you. Today's society, we have a lot of grandparents that are now moved back in with there's a $500 tax credit for a relative that is living with you that is not a child under age 17.
Excellent, good. I'm gonna ask Chris Border to stand up. Chris, because this is thrown right to you. And I'll ask Jed to comment on what you say. How does the new tax law affect the way I'm going to manage retirement money?
I have no idea.
Yeah.
I mean, thus far, there's a number of different things that it could, impact, but it also depends on where the income's coming from and how it's being done, et cetera. So Jed and I were talking a little bit about it. For example, you may get a 20% deduction on your K-1 income, which we've never seen before, right? So we lose your business expense deductions and things of that nature, but you gain it over here. However, if you're service companies that can kind of get into a little bit, you could be capped on that. So realistically, the way we would look at it is say, obviously you want to pay yourself first, right? And with business owners, one of the strategies that we try to help them employ, and not all of them do, right? When you take $1,000 and put it in your business and get a 25% return, it's hard to argue with that because there's no market-like investment that would do that. But diversify, because downturns happen, things occur, right, where you redirect those incomes. But most of the major retirement style vehicles, your simplified employee pension plans, your 401k, your IRA, things of that nature, really no major changes. Some limits, bump up as it cruises along with inflation. So as long as you're continuing to fund them, they're going to work for you formally at retirement.
Yeah, there was a big concern, especially in the TPA business, that with low tax rates, pension investing would stop. But that's not going to occur, because the rate has not dropped that low, especially for non-C corporations. Chris touched on something which is a little bit, I think, later in the agenda, but maybe we can get back to the 20% deduction and how pension planning can assist in that, achieving that deduction.
Okay, good. All right, change gears a little bit. The new tax law and its impact on divorces and alimony and things like that. You might comment on some of that.
Yeah, the simple thing is if you're going to get divorced this year. But the alimony deduction is going away. If you have a divorce settlement after 12/31/2018, alimony is no longer a deductible expense. Therefore, the alimony payment will stay with the payor of the alimony at their tax rate. Under today's rule, if you pay alimony, the payor gets a deduction and the recipient pays the tax on that income at their marginal tax rate. So obviously, the IRS has recognized that in most cases, the person paying the alimony is at a higher tax bracket than the person receiving the alimony, and therefore the arbitrage loss on revenue because of the decrease in rate was an issue, and they use it as a fundraising or increase the ability to give other deductions by creating revenue by making this change. The settlement does not need to be finalized by the end of the year, but it has to be agreed to by the end of the year. But so
All right, good.
that's going to be a big change.
Very much so.
I guess I should say that if you currently are paying alimony, you are grandfathered, so you will still get the deduction.
Okay, all right, good. All right. One of the most confusing aspects of the tax law is the alternative minimum tax. And I know that there were some adjustments.
There was a lot of hope that they would get rid of the alternative minimum tax, but that did not occur. They did increase the exclusion amount to about $109,000. So, and a lot of the ATM tax was created because of itemized deductions. So with the elimination of most itemized deductions, there's probably a good chance that even with the alternative minimum tax still in place, it will affect less and less people.
Got it, good.
I should say for C corporations, the alternative minimum tax was eliminated.
Okay. Anything on the estate tax?
Yes, the estate tax has doubled. So the exemption went from a married couple of about 11,000 up to 11 million up to 22 million. So that's going to give an opportunity for people that have large estates to shelter more of their value upon death. It also gives an opportunity for more gifting. So if someone has a substantial wealth portfolio, they can give more away and move that to the next generation or even the generation below that. The big concern is this sunsets at the end of 2025. So if you're going to do planning and you have a large estate, it's something you probably need to start discussing with your estate planner or your wealth manager now, because it's going to sunset. The other thing that they retain, which was a blessing, is this, what they call the step up in basis. Is if you are to pass away today and you have a piece of land that you paid $100,000 for that's now worth $1 million, your heirs will receive that land at a basis of fair market value or the $1 million. So the next day, they could sell that land with no taxation. That step up in basis doctrine has been retained.
Excellent, excellent. All right, so let's talk now on the business side. Okay, so here, how can the business and business owner take advantage of new lower taxes? What's changed in specifically?
Obviously, the C corporations, the rate has dropped considerably from 35% down to 21%. So now the C corp has come back into play. It's been fairly marginalized for the last 35 years. But with S corps and other pass-through entities that are the preferred format and structure for most businesses. But now a C corporation could be your choice of entity, especially if you have a quick growth plan and exit. There's a code section 1202 stock, which is qualified small business stock, that allows a business to sell their stock and pay no gain and eliminate it up to $10 million per shareholder, which is quite a benefit. But to obtain that benefit, you have to be a C corporation. So now you could see tech companies that don't have a lot of front-end earnings, being C corporations, and their exit is usually one done, overnight when their technology is achieved its goal, and it's a quick exit. So and then there's a lot of, that's probably the number one question we've been asked is, should I be a C corporation now? And usually the answer is no if you're already existing S corp. The only time that I can see it being beneficial if you've got a lot of debt and all your cash flow over the next 4 to 5 years is going to go to paying debt, maybe there's an opportunity to pay down the debt even quicker by sharing less with the IRS and paying more towards that debt obligation.
Very good point. Okay, write-offs, other deductions, meals and entertainment. I heard a lot of
Yes,
stuff about that.
everybody's aware, I assume everybody's aware that meals and entertainments, they're no longer deductible. They used to be deductible to 50%, now it's 0. The other aspect of meals and entertainment is that if you had a staff meeting in your office, you could deduct 100% of those meals if it was mandatory that your staff attend this meeting. So if you had a staff meeting, you brought in sandwiches, that was 100% deductible. That is now only 50% deductible. The other thing that the meals are still deductible if you're traveling. So if you have employees that are traveling overnight and they incur cost for meals, that is still deductible at 50%.
Yeah, so essentially, the new lower tax rates are causing the, I guess, in the eyes of Congress, the need to get rid of some of these write-offs and deductions.
Yeah, obviously to make it as revenue neutral as they could, they had to get rid of some deductions.
Yeah, so you can't have your cake and eat it too in that case, right?
That's correct.
All right, yes.
I don't know if you're going to add to this. Dave and I were talking earlier, we're talking about companies in the focus. Can we talk about how it will affect the benefits of organizations? I know we talked about maternity leave, and I don't know if we're going to get there, but I'd love for you to share that with the group.
Sure, great question. There is a new law for maternity leaves, is that if you have, and it's got to be written in your handbook, it's got to be a written plan that says that if you pay at least 2 weeks of paid maternity leave at a minimum of 50% of the employee's salary, you can get a 12.5% tax credit on the payment of that wage during the maternity leave. There is a caveat. You can only get it on employees whose wages are not higher than 60% of the highly compensated individuals. And I assume the highly compensated individuals will be the same ones as determined under pension funding. Yeah, so believe me, there have been a number of young ladies in our office that have brought that to our attention. Yeah. And I'll add to that is that the 12.5% is for 50% funding of the wage. If you go up to 100, that credit can go up to 25%. So it's a real nice benefit that for families.
Well, yeah.
I got a question. The $24,000 standard deduction, how does that apply to those that are itemized in the past? We make $100,000, $150,000 a year. Do we just take 24 grand off the top of standard deduction, or do we have to justify it against what we would have deducted had we itemized?
You just take it right off the
So
top.
take 24 grand off the top because you're a good guy.
Yep,
Okay.
exactly. And and I should say that if you're,
If you're not a good
if
guy,
you're,
you can take it as a
yeah, you get it even if you're not a good guy, yeah.
Yeah.
Yeah, I should say that if you're a single filer, it's only 12,000, and if you're head of household, it's 18,000.
Okay, great. Okay, there are a number of service, yes, I'm sorry.
I did the business interest deductibility, there's some changes on that.
There is that a business can no longer deduct interest expense that is greater than 30% of what they call their adjusted taxable income. Adjusted taxable income is basically your net income, but for the first 4 years of the law, it allows you to add back depreciation, amortization, and depletion. So,
There's some size.
and then there's also the exemption that if your gross revenue is less than $25 million, then that limitation does not apply to you. You know.
Okay, great question. Okay, there are a lot of service businesses in this room.
Yes.
Okay, and there was some very specific ruling on specified service businesses.
Yes.
Tell us about that.
If you've been following the law, they've basically said for pass-through entities, we're going to make it competitive with C corporations by giving you a 20% deduction off your K-1 income. So if you're an S corporation, you get a K-1 for 100 grand, you can take 20,000 off, so you only pay tax on 80%.
20% or 20,000?
20% of the 100, so it would be $20,000. This is the first time since I graduated high school that I feel like my algebra can come into play. Because there is so many simultaneous equations under this new law with the 20% that if someone here is a math genius, they can, if you can write an algorithm for us, we could sell that spreadsheet throughout every CPA firm in town and probably all over the country. The 20% is on its simple form. If you're not what you call, you know,
And what are those types of businesses? What are the industries?
oh, it's you know, most of us, it's lawyers, it's accountants, it's financial planners, it's anybody that sells their talent or makes their money based on others' selling of their intellectual knowledge. So basically, it's every service business you can think of. Two exceptions. Yeah, two exceptions is architects and engineers, is because they say that they end up building something in the end, therefore they are not considered a specified business, a service business. But the complexity of 20% gets wild for those entities. But let me go back to the 20%. Basically, you would think it's just right off the top, great gift. It makes the marginal rate for a S shareholder, a partner, a sole proprietor, it brings it down from 37%, which is the highest marginal rate today, down to 29.6. Well, that's fine if you sell something tangible, you know, you can get it without limitation. There is, and there's a bunch of different limitations that go into it. We actually have a little flow chart we'll hand out to everybody so they could follow along. But even if it's 20% of the 100,000 I talked about, it can't be any greater than 20% of your net taxable income. So if your net taxable income is only 80,000 because you have other deductions and other losses, then your deduction would only be the 16,000, not the 20,000 off the top. So there's, and then when you talk about personal service corporations, or what they changed the name to specified service businesses, is that if your taxable income is $315,000 and above, chances are you're not going to get that 20,000 at all, or that 20% at all. If it's 315 and below, you do get it, subject to, again, the other limitations. Limitations, again, being 20% of your taxable income, or there's another limitation on W-2 wages. You know, if you're W-2, you can't get more than 50% of your W-2 wages. Crazy, crazy law, and it's going to be good for us accountants because we're going to be doing planning calculations at the end of the year, every year now. There is one.
Yeah, I just passed this out,
Okay.
which is giving some meat to part of what Jed was talking about.
Yeah. This is going to be hard to follow, but hopefully it's something you can use as a reference point. If you recall listening to the news, right at the end they needed some votes, and Senator Corker from Tennessee is a big real estate holder, and to get his vote, they also added a provision that if you own real estate, the pass-through income from the real estate could also benefit from this 20% deduction. But because the 20% it's the lesser of the 20% or 50% of your W-2 wages, who has wages when you have real estate? So basically they said that would never apply. So they added a third element to it. They said another threshold is 25% of your W-2 wages plus 2.5% of your unadjusted basis in your assets. So if you have $10 million of real estate that you're earning $1 million to the bottom line a year, you can take 2.5 times that $10 million of real estate, or $250,000, and take that as your 20% deduction. Obviously, in my example of $1 million, that would be greater than the 20% of the $1 million net income, so you'd be limited to the 20. So real estate is still an option to gain this deduction. There's a little bit of concern is real estate a significant trade or business to fall under the allowable amount for the deduction? And what I've read so far, that if it's a triple net lease, you may be in trouble and not be able to use it. If it's not a triple net lease, then maybe you can. But that, we'll find out when regulations are released on how stringent that will be.
Jim, can you talk a little bit about, because rental properties, I see it more and more now, we're getting bigger numbers of them. In terms of, they create an entity that owns rental property, but they take no W-2. Can they contribute to a simplified employee pension plan or a 401k?
They cannot. You need earned income in order to do it. So I could, what I could see is, if you're a substantial owner of real estate and you currently outsource your management fees to a third-party management company, if you're paying enough management fees, you may just create your own, management team, have the wages in there, and now have to be able to take the deduction for your real estate income. But going back to what Chris said earlier, Chris and I had a discussion that said, when does pension planning and this 20% come into play? A perfect example is you're an accountant like I am, and your income is above the 315 threshold. That if you were to install a 401k plan in your business, or even something more aggressive, you could fund the 401k plan, achieve the deduction, bring your taxable income now below the 315, and get the 20% write-off. So basically, by putting in that in pension plan into your business, you may get the IRS to pay the full benefits that you have to pay to your employees, and maybe more. So there is going to be some interaction between specified service businesses and pension planning and that 315 threshold.
Are those permanent?
Yes.
Is that part of the permanent?
Well, most businesses' deductions are permanent. Most of the individual ones sunset at the end of 2025.
Right. So we did it in this fashion because these questions were actually part of a 1-hour presentation. So imagine we're getting this done in 30 minutes. But this was probably the easiest way. I will say that the document that you have is a good guidepost if you're a business owner. If you have questions, certainly we are here to help you with that, or just share it with your existing accountant. Last question, because this is always a thing, and I know you touched on it, but everybody's talking about the C Corp rates. Will my problems, if I'm an S Corp, be cured if I change to a C? Is that the catch-all? Well,
the biggest thing about a C corporation is double taxation. We've heard that forever, that, unless you qualify for the 1202 deduction, you pay tax twice. So if most small businesses, if it's a long-term play and it's your business, it's your job for a long-term, being a pass-through will probably still be more beneficial. But, if you plan on going public, if you have a lot of fringe benefits, those are the times which you see the C Corp more viable.
So I have a question.
Go for it.
First of all, algebra, architects, engineers, and build company.
Yes.
Websites.
Not a physical.
That's physical.
Yeah. No, you have a good point, because it's going to be, we're going to have to wait on the regulations to determine that. Like, again, Chris and I were talking about his industry. They have basically two forms of revenue: fee-based asset management and insurance products. Traditionally, insurance companies or insurance agents were not considered personal service companies because they actually handed you a policy. So they were getting a commission on that product. They weren't providing you financial advice. So companies like Chris's may choose to bifurcate their company, have one side of it being the insurance company that sells the insurance product and not be subject to the
Specified business.
specified business rules, and then the fee-based side would be. So there may be other parts of businesses that will break in two in order to achieve the deduction without the limitation.
You're a software engineering company.
Yeah,
There you go.
there you go.
Okay, we are right on point. Jed, thanks for your insights, and we're on to the next one. All right.